Hello and welcome to this session in which we will keep working with options how to finance your education. We looked in the prior sessions at various tax-efficient vehicles to finance your education, such as 529 plans, prepaid and savings account, the Coverdale Education Savings Account, and Series EE bonds. All these vehicles, they assume what? They assume that someone has money and they can save money for their child, grandchild, whoever they want to save money for. Well, oftentimes that's not the case. Oftentimes, students don't have this leisure. Leisure means parent or grandparents or relative that can help them finance their education. So what do they rely on if they don't have these options? Well, student loans. Student loans are a common method used to finance your college education. Well, student's loan is basically a loan. It's not a scholarship, it's not a grant. When we say a loan means it must be repaid, making it important for the students to carefully plan their finances as they can repay those loans. So just because it's a loan and you're not thinking about it now, you have to pay it later, you have to plan ahead. Like as a student, don't over borrow because you have to pay it back with interest. Bear in mind, even if you don't complete your program, you don't get a job, you are still responsible for paying the federal student loans. There are, under certain conditions, they can be forgiven, cancelled, or discharged. Very specific conditions. Otherwise, you have to pay it back. So in this session, we're going to look at the various type of options for loans as part of the tax planning and compliance, the CPA exam portion. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
One of the loans that students can qualify for is the Stafford Loan. This is one type of a loan available to both undergraduate or graduate student. This loan is determined based on your financial need. What does it mean based on your financial need? It means they don't care if you have a good credit or not. Need means if you are in need of this loan, you are going to qualify. Now, how to determine the need? Well, students will have to apply through their college for financial aid. They will submit an application showing what's their assets, what's their income. Then they would look at their expenses at the college. And if there's a gap, then you qualify for this loan, whether you have a good credit or not. So it's calculated by subtracting any other financial aid a student received from the total cost of attendance. Now, these loans are provided by the U.S. Department of Education. It's a government. It means they have a flexible repayment options. So what happened? What do you mean by flexible repayment option? For example, after you graduate, they give you 6 months. And under certain conditions, they might extend it if you can't find a job. But eventually, you have to pay it. Like during COVID, they did extend it for more than a year. And there are two categories of the Stafford loan, so that they're not all the same. There is subsidized and unsubsidized Stafford loan. So we need to be familiar with both, just so you know what this is. Now, you should be familiar with the word subsidize. Subsidize means what? Subsidize means someone is helping you somehow, subsidizing. It means they're doing something you're supposed to do. What is that subsidy? We're going to see. So Stafford loan, as we mentioned, are need-based. For those loans who are subsidized, the government pays the interest. They don't pay it. They simply don't add it to your principal while the student is in school. So if you have, simply put, if you have subsidized Stafford loan, you can think of as an interest-free loan when you are in college. So during any period of deferment means you don't have to pay it in college or after college if there's a reason, or this is called the grace period before payment. They give you a grace period. Once again, grace period during COVID was extended several times. And because of that, there's no imputed interest to compute also, because remember, if you get a loan and you don't have to pay interest, basically it's a revenue for you, not at all. There's no imputed interest. And having a zero-free loan, that could be a huge reduction in the cost for the student to get their education without incurring additional costs. So that's a great deal. So subsidized loans are good. Why? It's basically interest-free loan. It's not only interest-free, they wait for you until you should be able to pay it. Let's discuss now unsubsidized loan. What does that mean? You're by yourself. There's no help from anyone, from the government. Nevertheless, it's a loan. It's not based on financial need. So it's not solely based on financial need. So you have to qualify for this. Eligibility depends on the student's year in school, what year are you in, the cost of attendance, how much it's costing you, and from what other sources of financial aid do you have. Unlike subsidized loan as well, students are responsible for the interest, paying all the interest that accrues during time in school, and any deferment period and any grace period. What does that mean? It means if you're not paying it, interest is being added to the principal as time goes by. And what does that mean? It means by the time you graduate, you're going to have to pay the original loan plus all the accrued interest. Now, again, you can pay the interest if you choose to, which is going to help reduce your cost, assuming you have the money. So it's possible for a student to be eligible for both. Because remember, the subsidized loan, they might be a limited amount. You know, the government will change this amount from year to year. So you may get subsidized, then some unsubsidized loan. First, what you want to do is you want to maximize your subsidized loan as much as possible. And if anything left, you'll go into unsubsidized loan. So the specific amount and the type of loan a student can receive will depend on their individual financial situation and how much the university or college will cost them. There's also something called parent loans or the plus loan. Those loans are for undergraduate student, and they are type of federal student loan designed for the parents of the undergraduate. So rather than you applying for the loan, the parents are applying for the loan. So the loan is under the parents, but for what purpose? To finance their student kids. These loans allow parents to borrow fund to cover their child educational expense. The amount that can be borrowed depending on the total cost of that university, minus any financial aid received from other services. The parent loan, unlike some other type of loans, are not based need. You have to qualify, and you have to qualify under the federal government, but nevertheless you have to qualify as if you are applying for a loan, and you have to have some good credit worthiness. This means that the parent applying for the loan must have a credit history that meets certain federal standard that may be a little bit lax than a regular bank. Nevertheless, you have to have some sort of a good credit, decent credit. So it's important to note here also that the parent are responsible for this loan, not the student. Why? Because it is a parent loan. It's called that. It's also known as a plus loan. Let's take a look at this multiple choice questions from farhatlectures.com. Which of the following is true? Let's take a look at this multiple choice questions from farhatlectures.com. Which of the following is true about unsubsidized loan, not subsidized Stafford loan? When we're looking for a true statement, it means there are 3 incorrect statements and 1 correct statement. So if there are 3 incorrect, let's start by eliminating the obvious incorrect ones. D, they are available only to graduate students. Why not? Graduate and undergraduate can have them, therefore D is out. It's not a correct statement because it's only is not correct. They are awarded based on academic performance. Not really. Scholarship or grants from the college are awarded based on academic performance. Therefore, A is out. So we're down to B and C. They are need-based and no interest accumulate while in college. The borrower is responsible for all interest that accumulate through college. Just let's focus on interest because that's the only difference between those two. So, unsubsidized, guess what? You are responsible for all interest that accumulates even if the student is in school. Therefore, we'll make C is a correct answer. The borrower is responsible for all interest that accumulates even if you are in school. Versus if it was a subsidized loan, then you are not responsible for all interest that accumulate, especially when you are during school. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you do better on your CPA exam, enrolled agent, accounting courses, whatever you're studying for. Invest in yourself. Good luck, study hard, and don't borrow too much for college.